Welcome to the Explainer. Today, we're putting Xencor, ticker XNCR, through our ultimate valuation gauntlet. If you want to know exactly how the greatest investment minds in history would value a cash-burning, pre-revenue pipeline machine, you are in the right place. Let's dive in. Here's our roadmap for today. We'll start with a quick snapshot of Xencor, run it through the Buffett and Lynch lenses, check it against Benjamin Graham's defensive framework, build a discounted cash flow valuation, look at a couple of alternative models, and finally, wrap it all up with a synthesized recommendation. Part 1. Let's get a quick snapshot of Xencor and see exactly what we're dealing with. Xencor recently closed at $17.47. This is our benchmark, the starting line for the entire gauntlet. We have to ask, is this price a massive bargain, or is it a value trap just waiting to spring? Let's look under the hood. Now, check out the sheer contrast here. We've got a market cap of $1.18 billion, backed by a really massive cash pile of $541.8 million as of Q1 2026. But the earnings per share, it's sitting at negative $1.71. That translates to a brutal net loss of nearly $129 million in just the first quarter. It's the classic reality of a cash-burning biotech, especially one that just saw revenues absolutely plummet by 86.2% year over year, down to a mere $4.52 million. So to understand why those numbers look the way they do, we have to look at what Xencor actually does. They're a clinical-stage biopharmaceutical company focused on engineered antibodies for cancer and autoimmune diseases. They use this proprietary XMAb platform, which is a big deal because they've secured strategic partnerships with heavyweights like Amgen, Pfizer, AstraZeneca, and Lilly. The big hope here relies on pushing their wholly owned pipeline, specifically candidates like XMAb 819 and 942, through some incredibly complex clinical trials. Moving on to Part 2, let's view Xencor through the lenses of two absolute legends, Warren Buffett and Peter Lynch. Channeling Warren Buffett, we have to weigh their technological moat against their financial consistency. On one hand, you could argue they have a strong economic moat with that proprietary XMAB platform and over 20 candidates in development. But on the flip side, earnings consistency? It's basically non-existent. They have negative return on equity, meaning they aren't generating a dime of profit from shareholder capital. Plus, there is a massive red flag, a major dispute with Alexion over Altamira's royalties, with Alexion literally withholding all U.S. payments. Since Buffett demands consistent owner earnings and a crystal clear margin of safety, he'd pass on this stock in a heartbeat. Now, what about Peter Lynch? You know he loves to categorize companies. So are they a fast grower? Definitely not. Revenue just fell off a cliff, dropping 86%. A turnaround? Way too high risk given they rely entirely on clinical trial outcomes. But Xencor does fit perfectly into Lynch's asset play category. That $541.8 million cash hoard, that gives them an exceptional runway straight through to mid-2028 without needing to dilute shareholders anytime soon. But hold on, because Lynch places a huge emphasis on insider activity, and he'd spot a glaring red flag right away. Over just the last 30 days, we've seen heavy insider selling by directors like Charles Gorman, Kurt Gustafson, and Richard Ranieri. They dumped thousands of shares right around that $12 to $13 mark. And the kicker? Zero insider buying, not a single share. If the folks on the inside aren't betting their own money on the current valuation, Lynch would almost certainly label this a hold or even a sell. All right, Part 3, let's run this through the Benjamin Graham defensive lens. As you might guess, a cash-burning biotech completely shatters Graham's ultra-strict checklist for defensive investors. Sure, they pass the adequate size and financial condition tests, mainly thanks to that giant cash pile. But earning stability? Fail. They had a $128.9 million quarterly loss. Dividend record? Fail. There is no dividend. Moderate PE and price to book? Big fail, with a negative PE of 6.92. Graham would literally run for the hills. But we aren't stopping there. We still want to calculate Graham's famous intrinsic value formula, which is the square root of 22.5 times the earnings per share times the book value per share. The problem? Mathematically, this formula completely breaks down when a company has a negative EPS. And as we know, Xencor is sitting at negative $1.71. So here's the crucial point. To force Graham's model to even work for a clinical stage biotech, we have to cheat just a little bit. We have to explicitly assume a future normalized EPS. Let's just say a positive $1.50, based on highly optimistic estimated future peak sales, assuming their late-stage trials actually succeed.
Using those super optimistic assumptions alongside their current book value, we can spit out a hypothetical future gram intrinsic value. But make no mistake about it, at the current price, the margin of safety is virtually zero because those earnings simply do not exist today. And Graham's entire philosophy is built on buying what is, not what might be.
Let's move on to part 4, the discounted cash flow valuation. Now, building a DCF for a company burning this much cash, it requires some immense speculation. Our base case assumptions project out 10 years to capture clinical maturation. We're applying a hefty 12% discount rate, our WACC, our weighted average cost of capital. That essentially acts as our required rate of return for taking on the extreme dangers of biotech trials and that ongoing Ultomiris royalty dispute. We also assume a 2% terminal growth rate. To put it bluntly, this model demands we forecast massive future free cash flows just to justify overcoming today's losses. When we plug in these explicit, aggressive assumptions, we get a baseline DCF fair value per share. Basically, this is attempting to mathematically justify today's price tag by borrowing really heavily from tomorrow's potential success in the oncology and autoimmune markets. But if you look at this sensitivity table, you'll see just how fragile a biotech DCF really is. If we tweak our risk discount rate by just a couple of percentage points, say bumping it to 14% because a phase 1 trial underperforms, or if we just slightly lower our long-term growth expectations, that fair value absolutely craters. The intrinsic value here is incredibly elastic and entirely dependent on near-perfect clinical execution. Okay, part 5, let's cross-reference this with a couple of alternative valuation models. We ran a reverse DCF to compare against Wall Street comparables. Now, a reverse DCF tells us what the market currently believes. At $17.47, the market is baking in massive future growth expectations just to break even on today's negative earnings. Meanwhile, looking at 10 Wall Street analysts, their consensus is actually a moderate buy, with an average target of $24.25. But notice the wild spread here. We've got a low of $14 from JP Morgan all the way up to a high of $27 from Truist. That spread really highlights the deep uncertainty baked into this stock. Finally, part 6. It is time for our synthesis and final recommendation. This final scorecard summarizes our entire gauntlet. The traditional value gurus, Buffett, Lynch, and Graham, would honestly avoid the stock entirely at 17.47. It lacks earnings, completely fails the defensive checklists, and suffers from heavy insider selling. That leaves Xencor's valuation squarely in the hands of speculative DCF models and optimistic Wall Street analysts who are essentially banking on the XMAB pipeline hitting it out of the park. As an investor, you really have to weigh these polarizing factors. On the strength side, that $541.8 million cash runway to mid-2028, that is a phenomenal asset. It gives them the time they need to develop their promising XmAb 819 and 942 programs. But you can't ignore the risks, the severe royalty dispute with Alexion, choking off U.S. payments, a staggering 86.2% revenue drop in Q1, and those directors offloading their own shares. Ultimately, blending all these insights together, my final recommendation at this 17.47 price leans toward a hold. The cash definitely provides a floor, but the risks really cap the near-term upside. For the gurus to trigger a buy, the price would have to drop significantly closer to its cash value to create any real margin of safety. So I'll leave you with this provocative thought. Are you willing to bet your own capital on future clinical data just to defy the stark warnings of the greatest value investors in history? Think on that one. Thanks for joining me on The Explainer today, and as always, keep learning.